Hello, Pratik. I just started the
Hi
live.
Chanda, hi Scott.
Hello.
Hello.
Hey, we are live now already on YouTube. Just want to let you know. Share this one. All right, Pratik, you can do the introduction, right? I'll pass it over to you. Okay, thank you,
Yes.
Pratik. We go and start the webinar. We are at time. All right, it looks like we are at time, so let's go ahead and get started. My name is Chidachun. I'm with NACB and the Consultants Training Institute. Before we proceed with the May 12th, 2025 Around the Valuation World International Webcast, I want to go over a few housekeeping items. First, to obtain CP credit, you must answer all the poll questions that pop up on your screen during today's webcast. If you have an ABW International subscription, you'll receive the CPE certificate within 7 to 10 business days through your nacb.com portal. If you have any questions for today's webcast, please use the Q&A feature, as those will be directed to the presenter. If you have any technical questions or questions about NACBA, feel free to use the chat feature, as those will be directed over to me. So with the Around the Valuation World International Webcast, we have 3 editors. We have Wolfgang Nies, Andrew Newman, and Pratik Shah, and Brian Jones is also our advisor for the show. For the lineup today, we do have just a quick GACVA news item, followed by Scott DeMarco, who will be discussing the valuation of private equity and hedge funds. And just with the GACVA news, it's just a quick item that I had. I just want to remind everybody that our conference was recently announced. It will be in Salt Lake City, Utah, at the Hyatt Regency on September 11th to the 12th. In your material and also on the screen right now, you'll see the QR code. Feel free to scan that for more information about our conference this year. And with that, I'm going to turn the time over to Pratik Shah, who will get us started with the presentation today.
Thank you, Chanda. Thank you, Scott, for taking time out today. We would welcome you on behalf of NSCVA, GACVA, and happy to introduce you on Around the Valuation World. So before we get started, a quick background about Scott. So Scott is a qualified, certified business appraiser, certified valuation analyst, certified divorce financial analyst, and CPVA, which is certified patent valuation analyst. He has been involved in valuation of privately held business enterprises, professional and medical practices, professional licenses, advanced academic degrees, economic damage analysis, and real estate holding companies. Besides that, Scott has been appointed by courts as an expert witness, and his opinions have been adopted by the court system. He also draws upon his experience working in early stage tech companies and hundreds of business appraisals to accelerate an organization's value creation based upon innovative management, marketing, and technology. Besides that, Scott is a member of IBA, NACVA, Estate Planning Council of Eastern New York, Licensing Executive Society, Collaborative Divorce Association of Capital District, and New York Association of Collaborative Professionals. He has received his Bachelor of Science in Finance from Robert H. Smith School of Business at the University of Maryland, and an MBA in Information Technology from State University of New York at Albany. With this, happy to have Scott take over from here. Again, a very interesting topic and something very close to me: valuations of interest in private equity funds, venture capital funds, and hedge funds. Without too much of time, Scott, over to you. Just few couple of housekeeping questions. If anyone has any questions, please put in chat box, and Scott can take up as and when, there is, time to provide responses. Over to you, Scott.
Great. Thanks so much. I really appreciate it. So today we're going to be talking about valuations of interest in private equity funds, venture capital funds, and hedge funds. And so it's looking not at just, the actual funds, but in the management companies, the general partnership interests, the various different components of value that we'll talk about. So as we go through it, please, if you have any questions, I'll try to monitor the Q&A chat. So please, as we go through it, you can, put a question in there. And I don't have it showing up on my screen all the time, but I'll do my best to try to take a look at the Q&As as they come in here. So if you have anything, just throw them in there and we'll address it. If we don't get to it during the presentation, at the end, we'll go through it. So this is kind of the brief overview of what we're going to be looking at. The introduction to private equity, venture capital, and hedge funds. When I use the terms private equity and venture capital and hedge funds, private equity and venture capital are more similar, I'd say, to each other than they are to hedge funds. Generally, I kind of view private equity as kind of the umbrella type of asset category, and then venture capital is a subset of that because venture capital generally invests in earlier stage companies. And a lot of people see private equity also as kind of later stage, maybe even bridge financing to an IPO or growth capital. But private equity and venture capital are in more illiquid securities. Hedge funds are typically in more liquid securities. So there could be just publicly traded stocks, but they can get into exotic types of investments also. But generally, they're more liquid, and investors can get their money out quarterly, annually, and in private equity and venture capital, you're generally, for most types of those funds, holding on until the very end of the fund. But there are some newer structures that are called evergreen funds that give liquidity on maybe an annual basis or quarterly basis. So that's kind of a new model that people are starting to invest in. But generally, think about private equity and venture capital as the portfolio investments are more illiquid. The person's limited partnership interest is more liquid. Hedge funds have more liquidity overall. That's kind of a general type of difference. We'll go through the history of private equity and hedge funds, the ownership structure, and that'll lead into the components of value when we're appraising these interests. The interests are generally the number 5 there, incentive, performance, and carried interests. Those are the performance fees that are paid or allocated to the general partner. If you're in real estate, it could be called a promote instead of a carried interest. But they're all basically the same thing. It's a performance allocation. Management company valuation, that's really valuing the management fees and the operations of the management company. Number 7 is the capital account and waived fees. So that's you have an interest, you invest in the limited partner or the GP, and if the investment does well, you get your capital back plus a profit. That's a general just an investment in a capital account. And then we'll talk a little bit about private equity and hedge funds in divorce. It's more nuanced. We do valuation primarily for valuations in divorce in New York State, Connecticut, Florida, California, other states. But that's primarily where our practice is. We've done them for gift and estate tax valuations. We've done these for actual transactions, but our focus is more in divorce. And there's nuances there in terms of making sure that the valuations are in accordance with the local laws that are in place. So we'll touch on that briefly. All right. So the introduction, like I said, these private equity and hedge funds are complex. Can have very complicated ownership structures, and high powered deals are going on. They could be multi-billion-dollar deals that they're involved in. They can be valued, but you have to identify the components of value. So look at the appropriate valuation methodologies for each component of value. So for example, someone's capital account in an investment fund may be just looking at discounts to value. But if you're valuing the management company, it's likely going to involve a discounted cash flow method. It could involve a market approach. So there's going to be different methods for the different components of value. And then you can look at these in the context, not just in New York State, but if you're in a divorce in New Jersey or Salt Lake City or wherever it is, it's going to be a some important legal characteristics that you got to take into consideration when you're doing this. All right, so the first slide here, I actually created some of these images from last year using ChatGPT. So I told the ChatGPT, create an image that shows what a private equity fund would have looked like in the 80s. And this is the image that it came up with. So you can see there's a lot of computers. The computers don't really make sense. There's a world map. This is what and then obviously there's wood paneling in this probably Manhattan skyscraper. So it's really, this is what ChatGPT thinks private equity looked like in the 80s. But it has its origins in the 40s and 60s. So and then in the 1950s and 60s, limited partnerships began to form, and that allowed institutional investors to pool their capital together to do these private equity investments. But the whole industry really got going in the 1980s. And there was the RJR Nabisco leverage buyout by KKR in 1989. And that was one of the largest buyouts in history at that time. And it received a lot of publicity. Also, there was the rise of private equity giants like Blackstone and the Carlyle Group. And then probably it's the more modern era is the 2010s to present. The industry has grown substantially. There's private equity firms managing trillions of dollars in assets. So there's been a shift toward more significant global investments, increased focus on emerging markets. So right now, this is a huge asset class. In 2023, 2024, there's $8 or $9 trillion in assets under management. And many of these are illiquid investments. So it's a whole other asset class than investing in the New York Stock Exchange. And there's some kind of key characteristics that are shaping 2024 and 2025. Obviously, we all know about artificial intelligence integration. So private equity firms are deploying AI to transform the operations of the portfolio companies and of the firms themselves. They're trying to bring large-scale transformations across these enterprises, trying to optimize processes for back office operations and increase value. There's the infrastructure investment. So there was the Infrastructure Investment and Jobs Acts in the United States. So it's a growing area where there's been investments. We'll have to see what happens under the new administration, but there were a lot of investments, and there are planned investments in clean and renewable energy because of the government incentives. There's a real focus on value creation now. So there's a slowing pace of exits in 24 and 25. And so the private equity firms are starting to focus on growing their current portfolio as opposed to making a lot of new investments and exiting investments. So they're really focused on their portfolio, developing that value. A lot of challenges due to rising interest rates. So that's got a big impact on these firms in terms of how much debt they take on to do buyouts. And then there's other issues like sustainability, ESG factors. We'll have to see where that goes. That was a new area, and we'll have to see where things go from now. All right, and now this is what ChatGPT, in terms of that image, thought hedge funds looked like. It looks a little more professional. The suits are crazy. I don't know what those computers are, but I just obviously this is like some Manhattan skyscraper. I don't know if the Chrysler building's in the background. But you can see this is what they did in hedge funds back in the day, according to ChatGPT. But the first hedge fund was established by Alfred Winslow Jones in 1949. And so he had this idea to combine long positions, which means that you're investing in a company and you think it's going to appreciate over time, and then short positions. And the short positions, I think a lot of us know, if the company goes down in value, a profit can be made by the investor. So he combined long and short positions in different investments to try to hedge market risk. And he created it initially as a limited partnership. He's a really interesting guy. If you ever get a chance to look at his Wikipedia page or Google him, but Alfred Winslow Jones, he was actually a sociologist and a journalist. And he just wanted to minimize the risk of holding long-term stock positions by shorting other stocks. And really was to get away from that market risk. And that structure that he created is basically still in existence today. He's the one that kind of came up with the 20% incentive fee that would be paid to the general partner of the profits. And he came up with that. I mean, he was the sociologist. He was really big into history. He was a diplomat and a journalist. He knew a lot about the world and history. But in the age of exploration, ship captains and crews, they received a share of the profits from the cargo that they transported, and that was typically 1/5 of the profit. So that's how you get the 20%. And he said, well, that's what they've been doing for hundreds of years. That's what I'm going to do too. So that's where he came up with that 20%. Now it's not always 20% anymore. The 20% of profits for carried interest for in private equity or incentive fees for hedge funds is under pressure. It could be, but it could also be something different. It could be 25% of the profits above maybe a higher some type of internal rate of return based upon like the S&P 500. So maybe it's 25% above the S&P 500 is what the performance fee would be instead of just all profits. And the reason for that is if the hedge fund gets a 10% rate of return for the year, but the S&P 500 returns 15%, investors may not want to be paying a performance fee if that's actually not returning above the that S&P 500 return. Now, hedge funds, I think people are kind of have a misunderstanding about them. They initially were meant to mitigate risk, market risk. And so a lot of hedge funds, they would produce maybe an 8% annual rate of return, and the S&P 500 would produce a 10% rate of return. That's really how they're supposed to be, because then when the market goes down by 10%, the S&P 500 is down 10%, maybe the hedge fund's only down 5%. And so that's really, they're meant to generally underperform the market because they're supposed to have less volatility. But that's not really true anymore. A lot of hedge funds are actually looking to increase risk and beat the market or be totally uncorrelated to particular markets. So it's really different. It's different now than it used to be in terms of what it initially was. But then the 1970s and 1980s started to change for hedge funds. George Soros had the Quantum Fund, and he famously bet against the British pound in 1992 and did very well in that. There was the collapse of long-term capital management, LTCM, in 1998 that highlighted the risks and the rewards for hedge funds. And then again, you look to 2010 to the present, more of the modern era here. There's trillions of dollars in assets under management. And again, they're using quantitative strategies, algorithmic trading, big data analytics. They're making trades in fractions of a second, very high frequency trading for a lot of these hedge funds. And there's some of the similar things that are affecting private equity or affecting hedge funds. So there's the technological advancements in AI, changes in investor meetings and operations. There's a focus on private credit and specialty financing, and really trying to look at market volatility and interest rate environment and how they can make a profit in those particular areas. So it's an interesting time to be in hedge funds also. So we'll take a look at PC and PE and VC funds here. I'm just going to take a quick look to see if there's any questions. So feel free, if there are any questions, you can throw them out there. So we'll look at this first. So the left side of this slide shows the sources of funds for investment. So in the startup phase, which is the very bottom here, startup phase, FFF means friends, families, and founders. So that's where they're putting in $10,000, $25,000, or just sweat equity to get a company off the ground. So that's very early stage. Then you get into the earlier stage, maybe some angel investors will come into a startup company and they'll invest 100,000 or $300,000. So it's not millions of dollars generally, but it's hundreds of thousands of dollars and generally could be pre-revenue. Then you get to a little growth capital, and still early stage is venture capital. So venture capital companies are generally looking to invest, $1 million, $5 million to probably a pre-revenue company. Could be have some revenue, and they're looking to try to validate the idea and figure out the business model and grow the company. And then once there is probably some revenue, you get into private equity. These are later stage types of companies that they're investing in. And then the next stage is to have an IPO. That'd be later stage, or sell the company. So that'd be the last stage. And then you could also have mezzanine financing in here also. That's really just providing debt to get the company through to an IPO or some type of liquidity event. In terms of private equity and venture capital fund life cycles, the first few years are in fundraising. So they're out on the road and they go on a roadshow and they're looking to raise money from pension funds, high net worth individuals that are committing hundreds of thousands or millions of dollars to their funds. So that's the fundraising. So they go out and they try to raise 100 million or $1 billion for a private equity fund. Then the next few years, 2 to 5 years or more, they're sourcing and closing deals. So they're looking for portfolio companies to invest in. And so that's the initial stage. And then years 3 to 4, all the way to the end, they're managing and improving portfolio companies, and that's trying to grow the value. And then the last stage, they're divesting of the companies, exiting them. But there could be an investment early on, and then they sell the company in year 4. Or there could be an investment later on, and then they sell it very late in the life of the company, or the private equity fund. But generally, this is kind of the area that they kind of proceed over time. We'll go on to the next stage. So what we have here is private equity and venture capital fund ownership structures. So these are the ones where they're looking to have this type of kind of more complex ownership structure. Now let me just go back here. Oh, let me just check the chat. Okay. So what we have here is the ownership structure. At the very top, up at the very top, it says owner, general partner. This is the interest being valued. So this is if it's divorce, it's the husband or wife. They have an interest. That's this person here. Or if it's for gift and estate tax purposes, that's the person that owns the interest that we're valuing. And then at the very bottom, you have the actual portfolio company investments. And this structure is generally applicable to private equity funds, venture capital funds, and hedge funds. They can have a general structure like this. And so you can see you got the investments down here. There's the investment fund that goes out and raises funds from limited partners. So maybe 95% of the capital is contributed by limited partners in this investment fund. And then you have the general partner, and these are the employees of the private equity fund. They're the owners overall that are managing all the funds. Maybe they contribute 5%. I'm just kind of throwing out numbers here, but most of the capital comes from these limited partners. And then over to the right, you have the management company. So the management company is the business that pays employees, turns the lights on, pays the rent. That's where a lot of the expenses are in terms of managing these. And so they provide fund management here. And then you have the limited partners. The management fees get paid from the limited partners or the investment fund to the management company. And then if there's a profit that's earned on these investments down here, some of the limited partners' capital gets reallocated for that 20% carried interest, or maybe it's a 10% performance fee. It gets reallocated from the limited partners to the general partner. So this is how the performance fees, carried interest allocations are reallocated away from the limited partners at the fund level to the GP. And they would generally try to have the GP get a capital allocation instead of a fee that's paid, because there's more of a chance to have that be treated as long-term capital gains at a lower tax rate. then if it was all paid for as an incentive fee to the management company, it would just be ordinary income. And so they try to push it over, the incentive fees over to the general partner as a capital allocation instead of paying a performance fee as ordinary income. But it does happen. You could have performance fees paid to the management company, maybe for a managed account. And so that would just be ordinary income flowing through the management company. So that kind of gives you a sense there. And so let me just check this. And so then there's this slide here. It shows the feeder fund and master fund. I won't get too much into it, but this is a very simplistic structure. Believe it or not, I mean, we've had these where there's hundreds of different entities on an org chart, but you could have a master feeder structure. And the reason you have a master feeder structure, because the master fund could be structured to be domiciled maybe in the Cayman Islands, somewhere in the Caribbean, and then you have feeder funds, maybe a US onshore feeder fund, and then an offshore feeder fund. And you do that because there could be international investors that don't want to be subject to the US tax law or US regulations. So they come in through a feeder fund. That's the international feeder fund that goes into this master fund. And the same thing with the onshore feeder fund could go into a master fund. And then the master fund that's offshore can make investments in the US, can make investments in Europe or Asia, wherever. So they can do it like that. So that's called a master feeder fund. But that's generally they have that, but not always. So it's just kind of generally speaking. All right, so we'll go on to the next slide here. All right, so this is where we get into talking about the different components of value. The first component of value is the capital account value. Now, this is the general partner share of market value invested capital. So maybe me as the general partner, I decide to commit $100,000 to an investment fund, a private equity fund. They draw down on my $100,000, they make investments, and then maybe they return $200,000 back to me for the 100,000 I invested plus $100,000 in appreciation. And so that's what we're talking about with the capital account value. It's just like any other limited partner. Maybe there aren't fees that are paid by the owner. There could be exempt from management and incentive fees. But that's, pretty standard type of value. Generally with a component, something like that, component of value where you got a capital account, it's generally going to be a discount to value. And those discounts to value can come from various sources. There could be a discount to value based upon, there's surveys of transactions in the secondary market of private equity interests and even hedge fund interests. And so they actually do have somewhat of a market that's developing there. And you can look at those. And sometimes the discount, maybe it's zero. Other times it could be a 30% discount. And it's also based upon the capital class. So venture capital funds generally have a little bit of a higher discount compared to maybe like a leverage buyout, private equity fund, late stage. It's the values are a little more certain. And so you have a little bit of a lower discount. So it's really kind of make it as specific as possible to the private equity fund or hedge fund that you're valuing. The next one is the performance fee or carried interest value. And that's the owner's share of the general partner's carried interest or the incentive fees. And so that's we'll talk a little bit about that, but that's where it's a share of the profit that the limited partners earn gets reallocated to the general partner as a fee or a capital allocation. So we'll talk about that. The next one is the management company value. Now, management companies generally have more stable value than the performance fees because the management fees are generally paid every quarter. And performance fees, carrying interest, capital allocations, may not happen for years. They could be sporadic, but management companies get quarterly management company fees. And so that generally is less risky and there's value there, but there may be no profit is the problem. So that's something that we'll have to look at. The last one is the fee waiver value. the fee waiver works, and this is something to be cognizant of because you want to make sure you don't miss this in terms of doing evaluation. But the way it works is the general partner could say, please don't pay me my management company fees. I don't want you to pay my management company fees, limited partners. Instead, I want you to take those management company fees that you would have paid me and put them in my capital account, because the general partner will have to say, I'm committing, 5% of total AUM, I'm going to invest into this investment fund. And so what happens is it's another kind of loophole where the general partner can say, instead of taking those fees you were going to pay me in the management company, take them and put them over in my capital account. But there's certain tax issues to be wary of there. But there's definitely value there if they're waiving the management fees and having them invested in the private equity fund. That's definitely something to be cognizant of. And if you see anything about a fee waiver, make sure you dig deeper on that. All right. So the next one is allocating value in private equity funds. So, this is one of the trickier areas in doing these valuations, is understanding what's called the waterfall. So the waterfall for private equity venture capital, generally hedge funds are much simpler because they're paying performance fees, incentive fees every year. Private equity funds, it's not only about that particular year, but you got to look all the way back to the beginning of the private equity fund. So you got a 10-year life of a private equity fund, could be 12 years, but let's say it's 10 years. Something that happens in year two affects the whole allocation of this waterfall in year 10, or year 8 and 7, all the way through. So that's why this gets tricky, is because it's many years of these types of waterfalls that have to be run. It's really complex. And generally the way it works is when you look at these different tiers. So, and it's all referenced and laid out in the partnership agreement. Generally, you're going to read it and have no idea what they're saying when you first start reading these things. And then you kind of get a sense of, well, they're pretty much the same in each one, and they have different kind of flavors of the waterfall, but they have generally the same concepts. But so, for example, in this one, tier one, the pro rata value is allocated to the general partner based upon contributed capital. So if I'm a general partner, I contribute $100,000 to the fund. I get my $100,000 back upon an exit of a portfolio company. And then tier two is where there's a return of the limited partners' invested capital. So if they contribute $100,000, they get their money back upon an exit in excess of that $100,000. Tier three is you return the management fees, organizational costs, other expenses back to the limited partners that they were supposed to pay for along the way. So again, there's an exit of the portfolio company. Those fees have to get allocated to that investment also. So that goes back to the limited partners as part of their contribution. There's a preferred return to the limited partners. Generally, you'll see 8% as the internal rate of return to the limited partners. And that just means if there is only 7% total annual internal rate of return to the limited partners, there's no incentive fees that are or carried interest that's allocated to the general partners. But once you start getting above the 8%, there could be really significant fees that are paid to the general partner. And that's what that tier five is the carried interest allocation to the general partner. That's actually allocated above that 8%. I mean, this internal rate of return could be 6%, could be 12%, it could be above a benchmark. There's different flavors of it, but it'll all be in the limited partnership agreement. It'll be described in the audited financial statements for the investment fund. But you have to be careful about going with the audited financials, because I found errors in how the audited financials describe the waterfall, and they're generally just not as detailed as you're going to need to do the valuation from the audited financials. You actually have to get underlying documents, such as an actual waterfall would be something to request, and the partnership agreement. And this is how it goes, where if, like, say there's a private equity fund that raises $1 billion, and then they go out and invest that $1 billion and return $2 billion back to their limited partners, that $1 billion in profit could produce hundreds of millions of dollars of carried interest to the general partners. I mean, if there's no expenses, you got $200 million of that billion in profit that goes to the general partners. So it can be really significant once you start getting above the preferred return. All right. Let me just check this. Okay. All right. So this is an example of there's an example of an actual exit in a private equity fund, let's say. So it's a private equity fund and they exit an investment. So what this shows is that there was initially the limited partner contributed $400,000. That's this dark blue bar right here. So they contribute $400,000. And this portfolio company exit initially produces $700,000. So based upon the limited partner share of the actual investment that's getting exited, they are initially allocated 700,000 for their $400,000 contribution. So per this waterfall, the way it works, limited partner gets back their $400,000. So that's this dark blue. There's some expenses that were allocated, so $25,000 in expenses. In this case, there was a 9% preferred return. So that's just calculated on an annual internal rate of return. And so that's, in this case, it's $180,000. And then there's $40,000 that is allocated to the LP based upon the splitting of the profit here. Because of this total profit, we're looking at this from this light blue, two light blue things in the green. That's $220,000 in total profit that, or $220,000 allocated to the LP. That's 80% of the profits. And then the 20%, 55,000 goes to the GP. So of this $700,000 in portfolio company exit, the LP is getting all these blue kind of allocations here. So that's 645,000. And then the GP gets 20% of the profit, and that's $55,000. And then this is done for each limited partner for each investment that's being exited. They have to do this type of waterfall allocation to figure out how to actually divvy up these proceeds. And in this case, that's how the general partner gets that 55,000. So again, it can be really significant when you do this, when you're working with hundreds of millions of dollars or billions of dollars of investments. And then this is an example of how performance fees in hedge funds work. So you can see here, there's an initial investment. So some investor comes in and they invest $100 in 2016. The investment goes down to $80. So they're below this high water mark. When they contribute their money, they're at $100 for their high water mark because that's what they contributed. Goes down to 80, no performance fee paid. It appreciates from 80 to $90. Again, no performance fee paid because they're still below the $100 initial investment. And then it goes from $90 to $120. And so in this case, and this is calculated every single year for a hedge fund. Generally, it's a December calculation of each year, December 31st. Wherever you are on that date, you take a snapshot and see if you're above the high water mark. In this particular case, they're above the high water mark. There's $20 in profit above the prior higher water mark, which was 3 years in the past. So then $4 gets paid to the general partner in that case. And then you subtract off that $4, and $116 is then the new high water mark. And so then you look at 2021, where are they in relative to that high water mark? If they're below $116, there's no performance fee or incentive fee that's allocated or paid. If it goes up to $150, another incentive fee would be calculated at that time. So it kind of gives you a sense as to what that looks like. So there's a question here. So do you rely on internal valuations to estimate waterfall for PE and VC funds? I think it's a really great question. What I'll do, maybe I'll address that question right now. So what we can do is take a look at I was going to do this a little later, but we'll take a look. This is a redacted private equity fund balance sheet, very small private equity fund. And what it shows here, this is December 31st for the balance sheet. And what this shows is that there's investments at fair value. So these investments on the balance sheets of the private equity funds or the hedge funds will be stated at fair value. Cost of $33 million, and they're valued at $63 million in December 31st. Then they got some cash equivalents. They got $72 million in total assets. This $63 million is either done by an internal valuation team at the private equity fund. If they have a big enough company, they may actually do internal valuations. They could get external valuations that are done, but always the auditors are going to be looking at those valuations to make sure that they're good, so that the $63 million number is good. And that's what's done to allocate value as of each quarter end or year end. They're running these hypothetical waterfalls and running them at these values. Now, money won't get distributed, carried interest won't get distributed to the general partner until there's actual exits of the portfolio companies. So they will allocate value to your capital account as a general partner. They'll allocate, like if an LP wants to know what their capital account value is at year end, they will run this number, which is fair value, could be done, with a market approach, could be done with a DCF. But they're gonna allocate the value based upon those marks, the mark to market. But money won't actually be able to be distributed to the general partner until there's an actual exit and money's getting paid out. So that's a good question. All right, we'll come back up here. Okay. And so let's see. So we got that. So this gives us an example of the valuation of a carried interest and performance fees. Now, I'm not going to get into all the details here. This is just a very simplistic kind of understanding of how a valuation could be run. But generally, we're doing discounted cash flow method for more established types of companies here to value the carried interest and performance fees if we're able to get the documents we need. This is an example of a discounted cash flow. So you have to come up with a projected total GP carry, the carried interest. And so that's based upon forecasting when investments are going to be exited, how much they're going to grow by, and then you run it through the waterfall. And then the waterfall spits out these values here. And then you come up with the share of the owner, share of the general partner carry. In this case, they only have a very small carry, 3.75%. But you could have, partners that have 50% or 80% of all the carried interest. But in this case, they're getting 7 million. They're forecasted to get 7 million, 6.9, all the way through here. The next step is trying to figure out of the carried interest that's being allocated, how much is replacement compensation or reasonable compensation for that person's work, because they are working to generate that carried interest. Now, it could be zero if you've got someone that left a private equity fund and they're no longer working there, but they had vested carried interest and now they just get to collect that money. They're actually not doing any work anymore. In this case, we're assuming that this person is going to continue to work there and they are actually, in this case, we're assuming that they're going to 40% of the carried interest that they receive is the replacement compensation. So it's some type of assumption that has to be developed. You can look to guideline public companies as a source as to how to establish how much that should be for replacement compensation. We're not going to get into that. It's a whole other kind of series that we could do on that. In this case, we just pick 40%. So you subtract that off, you get 4.2 million in 23 of income before taxes from the carried interest. We just picked a tax rate. This is not the right tax rate, but we're assuming it's mostly long-term capital gains as of 36.5% for this particular state. So it's 1.5 million in taxes. There's the after-tax carry. And then we have present value. We have a 25.7% discount rate. Again, I just picked that out of the air. There's no real rhyme or reason for that other than it's going to be higher than if we're valuing a management company because there's more risk. So you present value that, and you can see over these 4 years, you've got $30 million in total carried interest that's allocated. The present value of that carried interest is only $5.8 million once you take out replacement compensation, take out taxes, and present value it. It comes down quite a bit. And then there could be additional discounts for lack of control and marketability. So in this case, we just took that off just as an example, and you get 4.35 million as the fair market value. So we're taking that, and this is a discrete type of DCF. The question next is, do you value this into perpetuity or just do a discrete valuation for a year, 5 years, 7 years, 10 years, whatever it is? So you have to figure out what makes sense to do that. All right. So there's a question, what do you do if this information is not available? Details of agreements, when things will be sold, and or detail of agreements. That's the heart of what we're trying to do in discovery when we're in litigation. Many types of investment funds will create budgets, they'll create forecasts. There are presentations that they've made to investors where they say, we're expecting a 25%, internal rate of return to you. They try to be careful about that, but because they don't want to make any forward-looking projections or statements, but often, they're giving investors a sense as to this is a 10% annual rate of return or a 30% expected rate of return. So they could have that. If they don't have that, in terms of a forecast, we have to develop our own forecast like we would do in any type of valuation. And so you can use industry sources. There's studies. So there's the Pepperdine survey that is very good about describing how limited partners are seeing the investment rates of return over time for venture capital, for mezzanine financing. So you can kind of see, okay, these are some industry statistics as what people are projecting these types of funds to produce. So you can do that. You can look at it, if I come into an evaluation and they're 5 years into the life of the fund, I know when those investments were made. They generally give a sense as to when they're going to be sold. And so you can just estimate based upon that, well, we've only got another year for this investment, or there's 3 more years for this investment. And they'll also give you in the financial statements the value of those investments and the cost of those investments. So you can see how much they've appreciated or not, and how much more future potential appreciation there is. So yeah, if they don't have these forecasts, we do it ourselves and have to come up with a forecast if there's nothing available. You can also work with an industry expert, which we do. We have hedge funds and private equity industry experts that are actually participating in the market. They may not be doing these types of valuations, but they see what's going on in the market and can help develop those forecasts. All right. So that's a good question. Let's go to the next one. So the management company. So when we got the management company, there's the management company receives fees, and that's what it uses to pay employee salaries, pay for operating expenses. The value of the management company, it depends upon the scale. So how much in assets under management, AUM, and the fund termination date. And they may have, the management company may have only one fund. Maybe they're on fund 1, or they could be on, I've got a fund now that's on fund 14 or fund 15. And so they have a long track record of being in existence. So that kind of goes to, well, are we valuing this into perpetuity, or are we just running out the current funds that they're managing? And so smaller funds may report losses if there's a small $50 million, $100 million in assets under management company. It's going to be hard for them to generate a profit depending upon the strategy that they're pursuing. So there could be losses at the management company that are funded by the general partner with performance fees or carried interest that's generated at the general partner. So you may have to run some losses at the management company to get those performance fees allocated from actual exits of companies. And then the larger funds can generate cash. And that's where we're talking about, are we valuing this into perpetuity or discrete life? All right, so again, I'm not getting into all the details here. This is kind of a very high level overview. In this case, we've got management fees that are paid each year. So you can see it's $13 million in 2020. And basically, you can just kind of run this out based upon how the management fees are calculated for all the different funds that the management company is managing. You have to come up with non-owner replacement compensation, and I'm just picking numbers out of the air here. So you get, in this case, and then we tax impact it. And then in this case, it produces profit. So you got 2.3 million in profit in the first year, up to 4 million in 24. Again, I took a 20% discount rate here. That's lesser of a discount rate than valuing the carried interest from the prior example, because these fees are paid every quarter or generally it's every quarter. It could be every 6 months, could be every year, but it's generally quarterly that they're getting that money. And in this case, we valued it into perpetuity, but doesn't necessarily have to be like that. There's statistics as to how long these types of funds can last. And there's things like such as, the prior performance goes into the longevity, expected longevity of a fund. So if they've had great performance, it could last longer. Fund flows are another thing to look at, is more money coming into the fund, or if it's like a hedge fund, are investors pulling their money out of the fund? And that happens too. And it can happen really quickly and really destroy value. So in this case, we took another discount, 15%. Again, that's not anything that is quantitatively assessed here. It's just a number that we picked out of the air. So you get 19 million in the value of net management fees. And so the value of the management company would be added to the value of the general partner incentive fees or carried interest up there. And the question here is, do you value the management company fees and the incentive fees or the carried interest separately, like I did in this case, or on a combined basis? And to me, it really depends upon how they actually do the accounting internally. We've had funds that group everything together and then they figure out how much of the profit should be allocated. In other ones, they see them very distinct and they should be valued separately. So it's really kind of a case by case basis. Another thing to think about here are the waived fees, the valuation considerations. So again, this is where I said, the general partner says, don't pay me my management company fees. I want you to invest it in my capital account instead. And then they make that allocation from the limited partners to the general partner to fund the capital account of the general partner. And then that can just go up or down based upon the value of the investments and the funds. So that's how that works. Something really to make sure you address in terms of value here. So then we get to capital account values. This is one of the key aspects of value here, one of the components of value. As we saw, the fair value capital account values are going to be allocated to all the different investors, including the general partners. And you're going to get a statement that I'll show everyone soon that says, this is what my fair value capital account is. Now, since that assumes that the investment fund is liquidated on that date, so if it's a 12/31/2022 fair value capital account, that's how much the investor would get if everything had been liquidated on that date. Now, if it's a private equity or venture capital fund, those investments are not going to obviously be liquidated all on that date, or maybe even in the next year. There's an expectation that you're going to have to hold on to that capital account for a number of years to realize that value or any appreciation. So there could be discounts for lack of marketability and illiquidity, and discounts for lack of control. And there could be taxes. So if there's a lot of unrealized gains in the capital account, if it's a divorce, you may have to look at the local case law and see should those taxes be taken out or not. But it's definitely something to take a look at. I think this is a presentation I've given to attorneys who many really understand this. I think a lot of us understand how the taxes work. But if you got an initial purchase, you hold the stock, you got an unrealized capital gain in your capital account, shows $125 for your capital account. Taxes aren't paid then. It's not until it's actually sold and there's a $40 realized capital gain. So that's more, if we're in a divorce, it's really a question of the local law as to whether or not you reduce for imputed capital gains taxes or not. So it's something to definitely take a look at there. And then there's these issues in divorce that you could think about. There's equitable distribution, post-marital efforts or active future efforts, something to really think about. That's an issue in many states to deal with, not every state. The management company valuation, are we valuing into perpetuity or finite existence? Are we assuming new funds are going to be created to support the management company, or are we just valuing it based upon the funds that are in existence? There's the vesting of ownership interests. So you could have carried interest allocated to you, points or percentage of the carried interest, but it's not fully vested on the date of award. You could lose it if you leave maybe in a year and it's got a 2-year vesting. You could lose 50% of your carried interest or if you leave early. So it's, how do you deal with, unvested carried interest or ownership interests? And then you'll also run across profits interests. So that's a different type of ownership where maybe your profit interest can be bought back for $1. So you have an interest in the management company of 5%, but if your employment's terminated, it gets bought back for $1. Or the profit interest could be that, we're going to value it. Or if the management company is sold above a valuation of $200 million, then we'll give you 5% of whatever the proceeds are from that sale. So profits interest have many different flavors and things to consider, but that's another thing to really think about, as opposed to just like it's a different type of just owning stock in Microsoft. You have a claim on the assets and the profits of that company, profits interests. You got to really look at the specific flavor to see what the rights are. So I'm going to show a couple examples in the last couple minutes that I have here of we looked at this balance sheet already. So what this shows is the actual investment fund, $72 million in fair value assets. And then you got $2.2 million in fair value liabilities. That means that total partners capital is 70 million. Just the 72 minus the 2, you got 70 million in partners capital. And that's allocated to $12.6 million to the general partners and $57 million to the limited partners. So that's part of the waterfall allocation goes into divvying up that 70 million into these two different buckets here. And then we go to the next page and you've got your income statement. Very little interest income here. There's all these expenses. So there's a lot of it's, expenses, or this is management fees that they have to pay to another entity. So that's something totally different. And then so that comes out of the investment fund that gets paid to the management company. Professional fees, you got auditors. And so this investment fund actually had $1.8 million in net investment loss. So the company lost $1.8 million, but they had net realized gain from investments of 60 million, net change in unrealized depreciations from investments of 41 million. So they had $18.6 million of net realized gains and change in unrealized depreciation. So you got a total increase in partners' capital of $16.8 million. So operating wise, they didn't really generate any profit at the investment fund level because they, have these management fees that they have to pay to the management company. But the actual investments in the portfolio and in the actual investment fund generated a profit. Now that's unrealized. Who knows what they'll actually turn into in the end, but that gives you a sense of, what these kind of financial statements look like. And then what happens is this $18.6 million, or I'm sorry, we'll go back to the prior page. This $70 million in partners capital then gets distributed to all the different limited partners and general partner as to a capital account statement. So this is a capital account statement. This particular investor invested they committed $500,000. $140,000 had been called down and deployed and invested in portfolio companies. So there's $360,000 left to be called down and invested. Generally, they don't pull down 100% of it. Generally, it's, it could be 80%, could be 98%, but it's not 100% generally. And so then you can see inception to date, because these private equity funds go all the way back to the beginning. You got a beginning balance of zero. $140,000 have been contributed by the limited partner. There's this investment gain or loss. So they lost $500 from operations. There's $532 in unrealized appreciation or depreciation. This one doesn't directly link up to the prior financial statement. And so your capital account is going to show $139,000 ending balance. And this is what, in terms of looking at valuing this $139,000, what kind of discounts to value should be applied to that? And should there be taxes taken out? In this case, there wouldn't be taxes taken out because they're below cost. But there could be discounts to value here if they have to be held for a while until they're actually exited. Let me just look at the QA here. Q&A. Yep. So the slides will be available for review for anyone that came in a little later. Again, we'll look at a K1. This is just a quick kind of understanding of a K1, limited partner interest. Now, the thing to be cognizant of is before 2020, K1 capital accounts, this partner's capital account right here, could be GAAP fair value basis. 2020 and to now, these are going to be on a tax basis. So you don't want to just go, I see a lot of people that just go right to the capital account on the K1 and say, oh, it's $334,000 is the value of my interest in this private equity fund. It's not true because this is just your tax basis. This is the cost with adjustments. The fair value could be multiples of this value. I mean, it could also be less, but it's going to be different. So it's really important to kind of not look at this for imputing value necessarily. And then the last page I just wanted to show was a management company income statement from a tax return. Generally, the management companies won't have audited financials. The management company, will have like tax returns we'll be doing our valuations on. But you can see this one's got 13 million in this would be management fees coming in, pay $10 million in salaries and wages. The partners are getting $1.1 million in guaranteed payments. That's what we got to bring to a reasonable compensation or fair market-based replacement compensation. And again, in this case, this produced a $3 million net loss. So it's something that, it's not able to really generate a profit. And the balance sheet of the management company, it's generally cash. I think it's some management fees receivable, but the management company doesn't hold the underlying investments. It's just directing the investment fund that holds the limited partner capital money as to where to make the investments, when to exit them. That's what it's doing. So that's why it doesn't have very significant assets relative to like $1 billion private equity fund. So yeah, so there we go. That's pretty much everything. I think if there are any questions, you can feel free to reach out to me. My name and email is on the slide. If there's anything, I'm happy to talk about it. So that's about it.
All right. Thanks, Scott.
Yep.
Thanks for joining us today. That was a great presentation. I also want to thank all of our attendees who joined us, as well as Pratik and Andrew. Our next webcast will be scheduled on June 16th. I hope you guys can join us then. And hope you guys all have a great week. Thanks again, Scott. Thanks for joining us.